Hello, can you hear me? Don't know what I can say other than this is my first broadcast. Um, I don't know if you can hear me. If you can, I need everyone to give me a thumbs up or tell me how you're doing. So, um, not sure what to say to get started. Um, I'm a value investor. I look at stocks that um, make you money, that make me money, so we can all make money together collectively. So um, you want REITs? REITs are really good, but you got to be careful of a couple things. How much do you have to invest? What to invest in? That's going to make you more money for your returns. The only way to do that is to look at your portfolio, and we can do a couple things. Show you some math, how to break it down so that you're maximizing your dividends per month. Everything comes down to monthly dividends. I don't care who you are or what you do. Um, all our billing, your phone bills, your records, your utilities, your internet, your phone, your home phone. Um, you want to buy a truck, got a loan, mortgage. Everything's based on either biweekly or monthly. So if it's based on biweekly or monthly, the first thing you want to do is start looking at stuff that's going to give you monthly returns. That also means that um, I don't know your budget. I don't know how much you can afford, but the longer you wait, the more stuff becomes more expensive. And for new startup companies, it seems like it's really good, but you have to be basically a shot in the dark or know a guru that you can trust. Now, most gurus out there um, will buy the stock and then promote the stock, just like everybody else. If they buy it, they want to promote it, and then when they want to get out of it, they're the last to get. They're the first to get out, and then you tell you to get out. So it depends on how you want to do that. Now, some of them are in and out of stocks really fast because they want to make a quick buck, and there's nothing wrong with that. Absolutely nothing wrong with that. That's awesome. But those are speculation plays, and I personally I like them and I don't like them. I don't like them because I don't like to sit on them and wait. If it pops 10 cents, I'm out. Okay, that's um, very good. And you can do that with stop losses on your stocks if you do stop losses. So if you buy something, you want to get out, and it's gone up 10, 15 cents, your stop loss is at 5 cents profit. Well, you have to own 10,000 shares. So you got $10,000 you want to play with. Your stock that you can buy 10,000 shares with $10,000 is around 20 cents and lower. So to get a 4 cent move, just to get a 4 cent move on that stock is very tough. It's more like 1.5 cents to 2 cents. If it's only 1 and 2 cents movement that you're looking at, you need to buy 50,000 shares. And that, my friends, depends on your budget. Okay, so um, you want to buy $50,000. Okay, so you have $50,000. You want to invest it in Maine, okay, or Stag, or you're looking at those type of stocks where Stag um, deals with malls. So they deal with Walmart, they deal with Costco, they deal with so they're warehousing that provide warehousing logistics to those companies. They pay damn good dividends, right? Well, they don't pay that great in dividends. They pay 12 cents per month, and they're expensive. They're $42 to $44. Maine's 44, Stag is 42, but Stag gives you 12 cents on the dollar. For every share that you own, they give you 12 cents. For Maine, they give you 21 cents every month on the dollar, but they're $44. So how many shares can you buy for 50,000? 1,100 shares. So 1,100 shares times 21, you can do the math, right? $230. Okay, Stag will give you $132. Okay, so on your $50,000 investment, that's not a lot of money. Yeah, 100,000. Now you're talking a little bit more. 100, 200,000, 300,000, 400,000, $400,000, and you've been taking it. You get more with Maine, so it's a bit more risky because it's business loans. And as you know, right now, I personally wouldn't loan a business any money unless I knew for a fact I was going to make money. So if I was buying if I was buying solar power, for instance, if I was buying solar, are they making any money? The only way they make money is government contracts, and those government contracts are few and far between. So you have to have somebody inside that knows where they're going to start funneling their money. Because with government, it's funny. It's ways that they get it is through government funding. Like if you go to Brooks, they have a huge solar power network. But why does it cost you more to have the solar power network in the first place when it's supposed to be free energy? That's a good point, considering that coal is run at $2 a pound or $1 a pound per coal, and you get 60,000 kilojoules out of it. To get 60,000 kilojoules, you have to generate so many hours of sunlight to get that. And then it's free, but the batteries or the condition of it isn't. So the transportation was where they nail you to the cross on it, which it doesn't make sense to me. But this infrastructure is already set up through coal, so that's why it's a differential. And this is why I have such an issue with, if anyone's watching, I have issues with the governments because everybody says, oh, we're going green. Well, green energy means oil prices are going higher, way up. Okay, why? Well, we've stopped producing it, so we're done. We're done producing it. We're okay. We're gonna not produce it anymore because we need to go green. So that means that, okay, so what are our alternatives then? Wind, which they charge you more for because it's not an infrastructure that they're used to. So they charge you more for the same thing, distribution. Then the solar power, well, they charge you more for distribution. So your bill, instead of being $140, now it's $300. Thanks for going green. Okay, but what do they do? They cut down the coal cost? Nope, they're still using it. The natural gas goes up, your utilities are going up, but you're still using coal. They haven't changed a damn thing. And then I heard on the broadcasting, I can even give you the link for it if you wish, about the difference in coal pricing. Okay, so the difference in, what am I trying to say? When you stop producing, you're causing the markets to go up. Okay, so it forces the oil to go up. Your exports, zero. Imports, everything. So it's 100%. So where are they coming from? Where's all this stuff coming from? It's coming from overseas. It's coming from our pockets because we're the ones paying for it to be shipped to us over our oceans, which is, is really safe. And it's a market industry. It's horrible. It really is. It's a double stamp. So all like Eastern Canada right now, they're all crying right now for oil and gas. Guess where it's coming from? It's either coming from Russia or it's coming from Saudi Arabia, which Trudeau loves, by the way, because if it comes from there, I'm doing my part. We're going to keep up with the Accord, the Paris Accord, which don't produce zero oil and gas. They give you nothing, but they want everything. And it comes at a price. Well, what happens? Russia increases their price, they lower their production. OPEC, what are they doing? Not a thing. Why? What did Trump teach them? If we produce our own, we don't need anybody. Guess what? Biden has got a contract with Saudi Arabia and Russia. So cut one, stop the other. Cut in the US. Now it's all import. So guess what happens? Oil prices go through the roof. He says climate change, boom. Everybody believes in climate change. It's going to take them 50 to 60 years to fix it. I'm afraid it's not going to happen fast enough. This is no way they're going to be able to fix it. They even came out and made a statement about uranium. How many uranium energies, how much uranium they need in the world, and then how many power plants will they need that's based on nuclear power. And they came up with a phenomenal number. They have 700 right now. They need to go 70,000 worldwide. Well, I don't know about you people, but that's a lot of nuclear power plants. And it takes 10 years to introduce one. 10 years. So how far behind are we? Let's face it, we're not getting rid of oil and gas anytime soon. We're not getting rid of coal anytime soon. All we're going to do is try to increase the amount of unpollution that they can force into it. So they already have the buffers to do it in China. They don't want them because it's too expensive. But they need them because of the air content. You think they're going to cut and go nuclear when they see what happened in Japan? With one almost melting down. Chernobyl. Look what happened to Chernobyl. It's still, as to up to this day, you can't live there. The radiation is way too high. So what does it tell you about nuclear power? It's very safe. Yes. And it takes 10 years to build one. And they're not in production at all. If you look at uranium prices jumped, but they're nowhere near where they need to be to start building them. So where are they focusing? Solar power, wind energy, which have been around since the 40s. 1940s, windmills have been around to produce energy. And what's the number one thing that produces the maximum amount of energy with the least amount of cost? Coal. Even hydro costs lots of money. The generators used for the dams are very expensive, and there's not enough dams. And they're not using the waterways to build your energy fields. Salt water is a marvelous thing. It eats away everything. So they don't like using it. They like everybody else, we want freshwater valves system. Lasts longer, doesn't rust as fast. Getting away from that, we're not talking about stocks. So let's talk about stocks. Okay, so if you have your $50,000 to invest, you break it down into 3 sectors. Okay, how much do I need to invest to get the maximum amount of profit? So if we looked at the $50,000, and I encourage you guys to look into this and really come back and challenge me on this. Okay, the best stock that I can find out there for anybody is btb.un. That's a real estate REIT, and they just bought a property that's supposed to give them 26,000 extra square feet to rent out. And it's going to push them over they're hoping it's going to be enough to push them over $1 billion in equity. Um, that's pretty damn good. They only make 29 cents on the dollar per share, price to earnings. Okay, so if you're not familiar with these terms, okay, so that's the earnings that a company produces, right? So per share, everything's per share. So if they don't make any money, it's going to be NA or minus beside it, okay, or it's going to be negative 03, 04, $1, $2, $3. If they have minuses beside it and they pay a dividend, they have to borrow the money to pay you the dividend. So that is a big warning sign and ones to stay away from. They have zero yield at that rate. Okay, that means that they're having a hard time and they don't want to cut the dividend. Um, and it's because a lot of them, COVID really hurt them, especially if they're dealing with malls like you were. If you're watching, everybody knows about the malls. Everybody knows about what's going on and what you have to say about it, right? So, what do you want out of it? The best money bang for your buck is the $50,000 divided by the $4.20 that they're currently valued at. Get you about what was it, 16,000 shares or 20. If you transfer from US, it's 27,000 shares, or Canadian is going to be just over 21,000 shares. So, and they pay a monthly dividend of 2.5 cents per share. So if you're looking at that going, well, okay, what's the difference between Main Street and Stag and BTB, or DIR and H&R REITs? H&R REIT and DIR REITs are fantastic. They're expensive, but they're great. But BTB gives you 27,000 US dollars to transfer from Canada, right? That, like, the 50,000, that's 27,000 shares times the 2.5 cents gives you your monthly intake of $362 Canadian. Okay, the $230 that you make on Main, you only have 1,100 shares. Okay, the most you're going to see on that money is about $48 to $50 a share. BTB's at $4. So if we do the math on this one, it should be sitting around $12 to $14. Under the fact that they're going to make more money and produce a higher dividend, because their yield's around 7%. Yields around 7%. So they have no problem paying you what is owed to you. Okay, so once they're able to rent out that space, they're going to be able to increase their dividend, increase their yield, and go get another property and make us even more money. That's what we want. We want that growth to continue to grow, especially in real estate when it comes to commercialized property. That's huge for us. As stakeholders of any company, where can you get that kind of return? So we're looking at 4 times their money plus the dividend. Make sense? That's why I recommend btb.un. Now, I'm not saying that there's more out there. I've been looking, but for the bigger bang to your buck, that's definitely it. And 4 times your earnings compared to 20%, 30%, 400% is better in my books. Plus, you're making more money per month. So if you had 100,000, you do the math, right? You had $100,000, you've doubled it. You have $200,000, you double it again. That would give you, 75,000 shares. 75,000 shares get you a lot of dividends per month. So then you're almost making $1,500, $1,600 just on the one company, and you get 4 times your money in 18 months. So 18 to 2 years, roughly. 4 times your money. So where do you want to be? That's my recommendation to you. Now, if you like risk, I got a stock for you. It's you may think I'm out to lunch on it. I've been holding it for almost 5 years now. I like it, but I don't like it, and you never fall in love with stocks. Just so you know, the reason why is they come and go like the wind. Some of these. This one is XTM.B. Now this is risky. I'm not saying it doesn't come with some risk. I've talked to the CEO. I've emailed them a few times, see how things are going with the company. Blah blah blah. What else can I tell you? They have nearly 40 properties, or just over 40 properties. If you know of Impala Canada, okay, so they're all branched of Canada. Now they have copper, they have zinc, nickel, cobalt, vanadium, palladium, platinum, and number one is gold. Okay, 2 properties in. Let's see, we're running the properties now. 2 properties in Newfoundland. One off the coast of Newfoundland, little island. They got Cape Breton Island. They got one in Nova Scotia, the Highlands. Majority of their properties is focused in Ontario. So the Abitibi Belt line, if anybody knows where it is, they got property right next to Kirkland Lake. Property right next to Owesco, Rio Tinto. Hold on, I'll let you. Yeah.
Be nice to your life. Change your clothes. See. Okay. Press the one that.
Which one?
The winner. Winner here. Press. That is me. Okay. So you have to put this add moderator. Yeah. Always when it turns into different color. Okay. So if someone is going with you, they can drop the link.
Oh, I see.
Okay. Everybody. This is my other account. Okay. I don't want to show because I'm live. Okay, don't remove. Don't touch anything there.
Okay.
Okay. So every time you're gonna put the moderator, and if you see somebody is bad, you're gonna press this again. Okay.
Oh.
Yeah, you're gonna press that again.
On them, you mean, or?
Yeah, sometimes people is bad. Okay.
Okay.
Okay, I should. Okay, press, and then
remove.
Yeah, you're gonna remove or time out. Okay.
Put user timeout.
Yeah. Don't put me timeout. I can't.
I know.
Yeah.
Top chat.
Yes. So I don't want to show there because somebody is looking at me because I'm in the live. Okay. Top chat. Don't touch. You can see here somebody is, and then I'm gonna do it again. I'm gonna go use my original account. Okay.
Okay.
Because I have 2 accounts. Okay.
All right. Well, I'm just trying this out right now. I'm just learning.
Yeah. Okay. Yeah.
So I was doing a live video feed for everybody, trying to spark your lives up a little bit and give you some.
But you are live. You are talking with me live.
Am I?
Yes, you are in a live. You see that? Is it red there? You see that? What is the time there?
Time here is 23:44.
23:44. The red one. That's the live. How many minutes you are there?
23:48.
23 minutes?
Yeah. Been live for 23 minutes.
Yeah. Okay. So that means you are live there, okay?
Mm.
So that's fine because I can do something for you. Okay. See here. Your camera is working. And then you're gonna do
the camera's working fine.
Yes. And then you're gonna do the background. Yours no bad background, okay?
Mm.
That's the one. Yeah. And there at your back because they can see that.
Mm.
Yeah, like that. Because I see you. Okay, I'll go back to my life.
You seen me?
Yes. I mean, be nice when you are in the life. Don't do something like that.
No.
It's distracting. That's, no, don't do that. Because you are in the professional. You're doing something new.
I'm just doing something new. All right. Thank you. So, yeah, like I said, XTM, trading at 13 cents. Their price to earnings ratio is 12.5 cents. So if you look at it and go, okay, they have 40 properties. What can you tell me about them? They have, like I said, what they have is a project generator. They like to have a project generator. They tried um, doing some hydro last year during COVID to make them money. Uh, to do surface mining because, like I said, the majority of their properties are on the Abitibi Beltline, and they got all in Quebec. I think there's 5 or 6 or 2 in Quebec or 3 in Quebec. Uh, Timmins, Ontario, Thunder Bay. Um, what was it? 2 years ago, they had a company offer one of their subsidiaries that are leasing from them, and their leasing is high. So between 28 to 38%. SPC just went public this year, but the company has a real problem with marketing. They don't like marketing for their strategy. So this is why the stock is not moved, is because poor marketing management when it comes to getting people out there that recognize the property, which means the volume is really low. And if you talk to gurus, that's big, big, big red flag. They need volume, big time, on their stock. And I've been talking to, like I said, the CEO about getting them motivated to do different things to see, help them try and understand what's going on with their stock. But they don't want to put any money into marketing or exposure. I don't know why. They like doing things for free. So when you do stuff for free, you have to constantly rebuild your image. So you have to advertise your company for free on like YouTube, like the platforms for investors that like mineralization stocks, which I'm sorry are at a favor. If you looked at the market, like I looked at BTG, you want to buy BTG, it's $4.10 US. Great company, makes lots of money, but they get bad press every once in a while. Alpha give them a sell rating, $6.85, and the stock got pounded because their quality of gold that they were producing at that time was low grade. They considered it low grade. It wasn't low grade. It was mid grade to upper mid grade, which means that they're not getting the amount of money that they thought they were going to get on the mineralization of their gold production in the 3 mines that they're producing through. But it was only one mine that was a low grade. The other ones were high grade to mid high grade of production. And now they're pushing now for that million ounces to break through the million ounces before the end of the year. So there's a big push for BTG. So um, I like the company. Uh, I like that they're in gold because gold, if you're an inflation buff like me, I'm very strongly against people who spend more than they make. So right now, the world economy, the world eclipses just more and more spending, which means more and more debt. So how you fight get away with debt? More and more debt. Eventually, it's going to force some companies, some not companies, countries, to go into receivership, and those countries will owe the U.S. Extremely a lot of money, and they're hoping that they can backlog the amount of debt load by forgiveness of their debt. So that causes an inflationary concern. So where else are you going to put your money? Well, to me, gold is a good option, but it isn't the option. Like it's good short term because as long as they're printing money, as long as they can't pay down their debt, it's a bad scenario. and it's being manipulated. Gold is being strongly manipulated by the governments because everything that we touch, everything that we have, including my computer, my monitor, uh, the rotors, everything revolves around RF, radio frequency. Radio frequency is in high demand. Our cell phones, our laptops, anything that communicates free wireless needs grounding. That grounding comes at a cost because that uses gold. Now it's not solid gold, it's gold plating. Gold plating on every device. Think about it. Every single device that needs RF, radio frequency, uses gold. So if gold goes too high, people can't buy the phones. They can't produce them because gold's too high. So what happens? They short gold. They have to. So when they go and talk to the governments, they short the gold. But the problem is the only solid asset class that they have is platinum and gold. This is it. They got nothing else. Silver, oh yeah, we use silver, but we don't use anywhere near what we use in gold. And you can tell that by the difference in the pricing. Before, there's a correlation between silver and gold, a huge correlation between the two of them. Now, it's like night and day. One's in pounds, one's in ounces. What do you tell? What does that tell you? I mean, you go and buy a bar of um, silver, you can buy 100 ounces of silver. They have it in cubics, heaven's sakes. So that tells you the difference right there. So they're not correlated the same. Before, it was correlated like 5 to 1, 10 to 1. Now it's outrageous. And there's lots of uses for silver, but not as anywhere near the usages of gold. So gold is a standard, but they can't standardize it because they can't afford it. There'd be too many shortages. Right now, we're looking at a shortage in the technology field for certain assets. So we're building on that. Um, thanks, Wen. Appreciate that. Looking great. Anyway, talking about XTM, 40 properties, stock price at 13 cents. Anyway, pushing XTM. I'm pushing it to have you look at it. Okay, you do the correlation for me. Okay, so the difference is that they have 40 properties. Each of the properties are probably worth around 50 million, between 50 and 60 million dollars on average, and that's no lie because some of those properties have platinum. And if you go with the Janus Lake, that's all in they're in Saskatchewan. So there's 3 mines in Saskatchewan, and Rio Tinto put $10 million up to do research and development of 2 of the big properties out there. And it's supposed to be like the second largest copper field on the planet. So if you think about that, that's huge, and that's millions of tons of copper. So copper right now is trading at $4.44. When XTM found out that they had the Janus Lake option and gave it to the subsidiary of FCM, and FCM was uranium mine at that time, uranium, solely uranium. Uranium prices went down, as everybody knows, because of oil and gas going down. Of course, it's going to have huge detrimental effects because if oil and gas is low, there's no way, and that was through the Trump era, that this happened. So why did Trump, and then 6 months after Biden gets in, oil goes $80 again per barrel? Okay, so getting away from XTM, I don't want to dwell on too much, but I look at it and say, okay, if Impala went and sold their product to implants for $1 billion, and they're a subsidiary of XTM, how much is XTM actually worth when it comes to asset class? Well, if it's 60 million, 60 million per property, 40 properties, $2.4 billion. They got 47 million shares outstanding with the exclusion of the options. Well, their employee options that they have are not for everybody. They're just for employees. But I consider that lost because you can't trade that. They can trade it, but that's within house. So it's the same thing, right? So it's 57. If you want to look at the whole picture, it's 57 million shares outstanding. But with the correction that 10 million of that is under options from the employees. So they're able to trade them publicly, but they're holding it for the employees. So that means that they're not available to me and you. So you look at it and go, okay, well, 47 million. You can put it out as 57 million. It really doesn't matter. And then you divide it and you come up with a number. And everything trades up where it's supposed to trade above par. Now, par, like I said, they make almost $9 million a year. They have 57 million shares outstanding. That puts their valuation at 12.5 cents. Minus, okay, there's no minus. But if you want to, there's $3 million in cash that they have. But that $3 million in cash usually goes into more properties. And they don't rate their profit on what the valuation of the land before and after when they bought it. So, like you and me, we go buy a property. You like the property, okay? What's on it? Oh, it's got some trees on it, so I gotta bulldoze a couple of trees down. I gotta flatten out the land. I want to put my house there, and I want to put my garden over there. I want to do these things. Okay, so right now, as it stands, I paid $70,000 for the land. Well, they paid $300,000, but they're buying hectares, right? 200-300 hectares. Okay, so if you're buying 200 or 300 hectares of land, and you're only using 150 hectares of that land to do your sampling, core sampling on 3,000 drill holes, and you have all your samples put in a row, and you come back and say, okay, well, what is that worth? Well, how much did you pay? I paid $240,000 for the property, and each of the drill holes is $4,000 or $5,000. So how much money is that worth? Well, it depends on what I found. Well, they didn't break it down for them very good. So if they turn around and someone buy or takes over their property, leases it out from them like a royalty, but it's not a royalty, it's a project generator. So the project generator, they give them the property, they take 39% for the first 5 years until it starts producing, and then they cut back slowly because they want to make as much money as they can when they first start. But when most companies start, they don't make any money within the first 3 years, and then after that they start making money. And XTM has been around since 2009 under Scott McLean. So he has started it back in 2009, didn't fulfill the XTM goal until 2011 when they went IPO. And after the IPO, within 2 years, we were making between 18 and 19 cents a share. Not bad. They only had 23 million shares outstanding. They were doing really well. Stock went up to 24, went up to 26 cents, 24 cents, 25 cents, and then back down, up and down, up and down, up and down. I got in, when did I get in? 2014? 2015? No, 2016. 2016 I got in to XTM. I looked at them and said there's huge potential here because of the amount of properties they have and their asset class, but they don't put their asset class on their books. And that's one of the biggest problems I have with XTM, other than the fact that they don't advertise their company, which is beyond me. You got a company that you have 14 or 15 licensed properties up for grabs. You paid $200,000 for them. They're worth about 70 or 80 million dollars in assets that's built into the ground after 5 or 6 years, and you don't know the potential of them. And they even said we got to stay away from potential earnings. There's a whole slew of stuff that they can't say, that all the companies say, and that's potential earnings, because everything's based on potentially what they're going to make, not based on what you actually make. Because what you actually make today changes tomorrow. And because you're involved in so many different aspects of your company, imagine 40 properties, you need a team to be able to facilitate the amount of knowledge based on the accounting, just on the accounting front alone, to tell you exactly how much each of those issuance of the core sampling is valued at, so that they can break down the best possible scenario of what is expected to come out of that ground every year. And that's a cost analysis of effectiveness per property on assignment. Um, because once you have an understanding of that, then it becomes a very easy sell to the next client. Because the first thing they want to know is how much money is in the ground. Because I got $15 million invested in my equipment. I got 19 guys that are willing to go right now on a moment's notice. But if there's only $5 million in the ground, I'm not drilling. I'm sorry, I'm not going to drill. Why would I drill if there's only $5 million in the ground? My equipment is $15 million. If it goes down for 3 weeks, I'm looking at anywhere between $17,000 to $30,000 in repairs, and then I'm not going to get it out of the ground anytime soon. So their cost analysis comes into effect, and then they are looking at it going, I'm taking a loss on this already. So there's no way. So you got to think like that, right? So there's got to be at least $50 to $60 million in the ground before they'll even look at it. And that goes for anything. So that's where you look at and going, that's where the 50 to 60, between 60 and $70 million on average, each property is worth. So that's why I said their market cap shouldn't be 12 to 14 million dollars. It should be in the billions, because of the amount of properties that are withheld and are reliable to people. So how much is a stock worth? Okay, well, just an asset class puts them at $9 to $10 stock price. Okay, that's fair market value. Now, as we both know, nothing trades at fair market value, or at least it shouldn't. Like XTM sitting at 13 cents when they're worth 12.5 cents doesn't make sense. It just doesn't make sense. No matter how you wrap your brain around it, that's just ridiculous. That means either they're not getting noticed, people aren't seeing them, or their volume is so low they're not attractive at all, and stay away from them. Okay, but the difference between a value investor and someone who's just trying to make a quick buck is they realize the potential, right? You see the stock can hit easy $90 to $150, and it can do it in a heartbeat. Lightning strikes more than once, and when the people catch on that this is worth this much money, they have this much gold, there's no way this is going to sit this low, especially when 98% of their properties are in Canada. There's only 2 properties that they don't have in Canada, and they're in the United States, and they're both in the Maine area. So the Maine, like in state of Maine. Okay. What else can I say to you? That's a welcome addition to anyone that's broadcasting or has anything to say on behalf of XTM. And my big push is XTM, but that's only because, and would I recommend it? I would hardly recommend that you look into it. I don't recommend that you buy it. Once they announce anything that says that they're going to start doing something about it, or you see the stock start to take off, you definitely want to put your money in it. But I wouldn't go too hard, too fast on any given um, paralysis of it. What else is there? Okay, so that's enough of that on XTM. Let's talk about WCP, Whitecap Resources, or Joy, Journey Energy. Um, right now, WCP is trading at $3.48. $3? No, they're making $3.48 for Whitecap Resources. Huge oil and gas company, um, and they're trading at 2 times earnings. So at $7.40, and they're worth approximately $28 to $29. Gives you some aspect of where it could go. That's 4 times your money in a very short period of time. That's huge. Okay. They also pay a dividend. It isn't great. If you're doing it for the dividend, you're going to be buying BTB, looking at BTB as your number one source. Why? It's $4.25. They're offering you 30 cents per year. That works out to 2.5 cents every month. Okay. WCP is offering you, ready? 2.25 cents. 2.25 cents. So if you're looking at them um, for a dividend run at 4 times your money, that's horrible. Uh, because you can't buy as many shares for one, and uh, and that's all the bottom line. You're not getting the maximum amount of revenue on your dollar, but you're getting the return when it pops to $27, $28 from 7, 28, four times your money, right? Okay. So let's look at Joy. Joy is also another good one. It makes 57 cents um, per earnings per share. No dividend. Trades at $1.83 currently. 59 cents times 3 puts it at $2 roughly. Okay. So you're almost there. But that's only 3 times your earnings. It should be trading at close to 10, between 10 and 16 times your earnings. But because it's oil and gas and it's risky as hell, because we have no idea that Biden is going to increase, and we know he is, increase the amount that he's going to say we need green energy. As soon as you hear that climate change rule, that means they're cutting even more oil and gas refineries in the US. Means higher oil prices. So your Joy or Baytex or Syncrude, Suncor, all those stocks going to start making you money. How much money? Quite a bit of money. I'm predicting WCB go to $28. Joy should be sitting around $6 to $7 right now. It's trading at $1.83. That gives you 6 times your money. That's phenomenal. But don't forget to put your stop losses in, people. So your stop losses are when you want to sell it before it dives. So you're protecting your asset. Let's say I bought it today. I went in and I said, okay, I'm going to buy Joy. I want Joy. I want Journey Energy because you make money. They're solid. I'm going to buy them at $1.79 or $1.75. Okay, I put my bid in. Buy it at $1.75. Never buy it at market because the next one you're buying at market. Okay, so if you want to buy at market, this is what happens. The market opens up at $2.80. You're in at $2.80. The next bid, the next asking price, $2.93. And then right afterward, not even 10 minutes, stock sits there and goes It was trading at 185. Now it's trading at 295 or 285. So that's $1 more. And the next bid on it is at 175. Well, you got it at 280. So 175 is the offer. Then everybody drops their price down. The askers drop their price down because they want to get out. Okay, so you're bidding, you're buying, and then there's a seller. That seller now drops his price down. You're already in at 280. You're going to be waiting a long time to get that money back at $2.80 in the port. The guy that sold you that at $2.80 is laughing because now he's able to buy it at 160 and he made money because now he's like double dipping at a lower price and he knows it's going back up to 280, but it's going to take probably a week and a half to 2 weeks before it goes back up there, or it might not get up there within a month. Okay, but he knows it's going back there, so he'll buy more at lower price, gives him a better option. Never buy at market. Just like selling it, if you want to sell a stock, wait for it to drop a little bit and then sell it. Don't go to the top and say it's going to sell, because what happens is you get this droppage. What you can do to protect yourself is called a stop loss. Okay, so you sell it and say, okay, well, I've already made 20% of my money. Do I want to get out? No, I want to wait for it. But what kind of risk am I willing to take to get out? Well, I'm willing to take a 20% drop. Okay, so I'm already up 20% on the stock. So I want to take a 20%. I'm not making any money. Well, because it's a higher valuation now that you're now looking at, you actually are making money. You're just only making 10 to 12 cents on the dollar on your money, but you're still making money. If you're 10%, means you're in the same area of 60 years and plus. You only can take 10% hit. So when it goes up 10, 20, 30%, you're 10% off of that. That's your stop loss. And you have to keep changing it, because if it keeps going up, you have to keep changing it 10% less than where it's trading at. It's just protection. Okay, so it's nothing new, nothing big for you. It's just your way of protecting yourself from that. So I can show you later. This was just a trial run for me to see if I could get people, or see how I sound live, because I don't have a suit on right now. I normally would wear a suit to talk about stocks, especially because it's a high profession, and it's a lot of criticism and wearing loose clothing when you're a professional talking about people's investments, people's money. People don't look at you as being very professional like, and that you don't have enough knowledge based to talk about the EBITDA, stocks, profit margins. I'm not a chart reader. A lot of people are, but that's how they get you deterred from even investing in the first place, because then they get you into ETFs, which are great if you just want to lock it and forget it. Problem with ETFs is you don't make the money. You know who makes the money on ETFs? The banks make the money and the ETF makes the money. That's who makes your money on ETFs. They get 30% when you give them your money right off the bat. They make 30% on your money right off the bat. Okay? Then they invest your money into 100 different branches. Think about that. So if you had $100,000, I'm going to invest in 100 different companies. How much am I actually getting of each company? And all these companies pay a dividend. But my return on my capital is less than 3%. But they're making 20%. Well, how is that possible? Some manipulation going on? No. What's happening is they're taking the profit right off the top before you even made a dime. So that's why they want your money. Telling you how to defend against that? Okay. Picking the right stock for you is vital. So when you're sitting down and you're looking at it, you want to take your margins and look at who's making what, where, how can I get the most for my dollar, and who's paying me the most so that I can invest the most. Okay, like they say, don't put all your eggs in one basket. Don't put all your eggs in one basket unless your basket is small. Okay, because you have to pick one or two or three or four. Well, the more you pick, the more diversified you are. Yep, more protection you have. Absolutely. The less you make. Great. So unless you're 20 years old, have $5,000 in the bank, you can afford to take some risk, right? But if you're 30, 40, 50 years of age, your risk tolerance becomes a little smaller. And when you're 60, you have no risk. 70, zero. So how much you want to invest? You want to invest as little as possible, but you want to protect your assets. The only way to protect your assets is a stop loss. So when you go in your account and you go into sell, because you own it, yeah, own this 1,100 shares of Maine, for instance. I want to sell Maine as a stop loss protection. So if it's trading at 44, my out is 43.25. I'm out at 23. At 43.25, I'm out. That's a 75-cent drop. I bought it at 42. I'm okay. I made a little bit of money. How much? I have 1,100 shares. Every time it goes a buck, I make $1,100. Plus, I get the dividend if I hold on to it for a whole month. And when I sell it, the tax laws when you sell a stock depends on where you're from. Okay, so here in Canada or in the US, you have 401ks. Now, the 401k is a tax break, but it doesn't prevent you from getting tax deductions if you are overzealous on your trading. So here in Canada, it's 30-day rule. If you buy a stock and it's cash, you have 30 days. After 30 days, you have to pay capital gains on it or look at it as a capital loss. So you have to be out of it for 30 days. Now, when they say tax loss selling, that is the end of the year, you're lost, so you want to sell it. And you have to be out of it for more than 30 days to claim it. So that's why everybody says, oh, the tax loss selling happens at the end of the year only. No. It happens all the time. The only thing is at the end of the year, it's the only time it gets recorded for the next tax year. So that's why a lot of people get confused and frustrated with it because, oh, everybody's selling. It doesn't mean they're selling. It just means that they're transferring capital from one division to the other division. That's all. You don't have to worry about tax loss selling until you start seeing the whole market sell off 10, 15%. Then you know it's a correction, not a sell off. You see any more than that per day, that's an issue. That means that someone has probably realized that we're over budgeted on everything and we can't afford nothing. And that hasn't come to fruition as far as I can tell. Everybody's like Warren Buffett hasn't come out and said anything, even though they're all gearing for it because they have a crap load of cash. You notice all these big companies have a lot of cash on hand. Well, the only reason why they have a lot of cash on hand, they don't want to invest it. Well, what does that tell you? That you shouldn't be investing? It tells you should be very cautious investing. So that's why you need to do these stop losses. So when you put in your money and you go, okay, what is my absolute stop loss? What is the most I'm willing to lose before this stock goes down any further? So even though it's only 10% and you can see a correction happening and pull up, most of the time when it does a sell off, it sells off. Okay, BTG went to $7.85. It started selling off and it went to lowest $3.20. It continually sold off the whole year. even though they were producing more and more gold, and their balance sheets were nowhere near what was going on with the company. They deserved to take a 10% hit, but not a 50, not a 60, not a 70% hit. They went below what they were in COVID first hit, which was amazing. I mean, you can buy the stock at before COVID, like when COVID hit, I'm able to buy the stock even lower than that. Are you kidding me? When they make 1,000,000 ounces a year, 1,000,000 ounces a year, and your stock sells off, tells you that there's manipulation going on, and that's huge when you see that nonsense, because you know for a fact that there's no way a 10%, 20% hit. No, 10% hit on the stock would have been sufficient. It would have sent them a message. But when they take a 60% hit, there's some manipulation, some strong manipulation going on. Alpha came out and said that they got a bad recommendation from Alpha, and as soon as Alpha got to the target price, guess who was loading up on it? The guys at Alpha. So what does that tell you? There's manipulation going on. Definitely manipulation going on. So when you hear those things and you see what's going on, you look at certain, like the Lion Stockhouse, but Stockhouse is it's a BS board for a reason. Um, Majority of what's on there is people who don't understand the markets, don't understand what value is. But if you look at Owesco, you look at Rio Tinto, you look at Kirkland Lake, all these were getting buy recommendations, but they're $40 freaking stocks. Okay, which means you need $200,000 to invest in them, and they're getting pumped up like crazy from Alpha, and they're going, well, these are really buying opportunities. But when you look at the balance books, you're like, what the hell are they talking about? They're nowhere near what BTG was trading at, like where he should be trading at. Um, their gold production for Barrick was awesome, but Barrick, it takes a lot to move it. It's got a lot of shares outstanding, and it's a big company, but they don't produce any more gold than what's coming out of their mine in near the Timmins, Ontario, Abitibi Belt line. So when you look at that and you're going, okay, if they're moving $5 or $6, and they're paying you a dividend, but the dividend is really small. BTG's dividend is really small. BTG was at $9.44 or $9 or $10. $9.99 it was the highest it hit. Okay. I don't understand the whole concept because, like I said, if you look at Ken Ross Gold took a 20% hit. That's big. Okay. What's the other one? I Am Gold. They shut down a mine, 2 mines in Quebec. One was because they had problems with the mine, and the other one was they had problems with the workers. They went on strike, and they shut it down. You know what their hit was? 20%. BTG, 60. The difference? One has Canadian fundamentals, and but not all their companies. And Ken Ross has had bought in BTG's mine in Moscow or in Russia. So if you look at it and go, well, that's very interesting, but it doesn't tell you anything. So you got to be careful with those things. If you have a stop loss in there, it protects your assets. So that's the bottom line. So if it was at $9.44 or $9.25 or $9.60 or $8 or $7 or $6, if your stop loss was only 10%, you're in and out. And you're out and you stay out until you start seeing it rebound. That means you're not buying it when it goes back up. As soon as it goes back up, you don't buy it right away anyway, because it can go right back down. So you want to watch that. Start watching for your double dips, right? That's your charting. I know I don't like charting, but that's your double dips. And when you know a company's making money, there's no reason for them to stop making money. If they're going to make 1,000,000 ounces this year, and they're going to make 20% more than they did last year, why are you selling it? Unless, of course, the production that they're producing is low grade material. Because if it's 20% of their high grade, that means their stock is only worth 20% of where it was prior to. So it's an 80% hit. But if that's on one mine, okay, so something to keep an eye on. And anyway, I'm going to call it a night. I'm getting tired. It was good chatting with all of you, and thank you so much for tuning in. I really appreciate it. If you like what you're seeing, please subscribe. And I'm hoping to do charting, and we'll get together and have a suit, and we'll see what I can do to help you out, try and make you some money. All right. Everybody have a great night. We'll talk to you later. All right. Bye.